So far, we've looked at passive investments and we've also looked at significant influence investments, aka associates. What we're now going to turn our attention to is subsidiaries, and that means control. So we're talking about entities where we control the investing, the financing, and the operations. Let's just remind ourselves of our learning outcome statements here. Remember, we've got 3 learning outcome statements spanning the entire reading, asking us to describe classification and measurement, distinguish between IFRS and US GAAP, and then finally analyse the different methods' effects on the financial statements and ratios that we calculate. Okay, so we're looking at control over entities, our subsidiaries. The key point to think about here, when we have control, what we're going to do is reflect the assets and liabilities that we control in our balance sheet, not necessarily the assets and liabilities that we actually own. I think it's worth being aware that when we look at subsidiaries, we can actually see 3 sets of accounts. Up until now, with our passive investments and with our associates, we've been looking at how it's recorded in the parent company's accounts. But when we turn to subsidiaries, we're going to see 3 sets of accounts. So what are these 3 sets of accounts? Well, what we're going to have in our 3 sets of accounts, we're going to have the parent company's accounts. Now, the parent company's accounts are going to reflect the cost of the acquisition of the subsidiary. So we're going to show the investment at purchase price. We're also going to have the subsidiaries accounts. And these, of course, are the balance sheet at their original values. In other words, we do not make fair market value adjustments in the subsidiaries accounts. And then the third set of accounts we're going to have are going to be the group accounts. Now, in the parent company's accounts, we said we recorded the investment at cost. In the group accounts, however, we're going to show actually what we've acquired via the investment. In other words, all of the assets and all of the liabilities of our subsidiary. So in the group accounts, we're going to see goodwill. Goodwill being the difference between what we paid to acquire the subsidiary and the fair market value of identifiable net assets. We're going to see the parent company's assets plus, essentially, the subsidiary's assets at fair market value. And they use a phrase, identifiable net assets, when we look at the subsidiary, which means if the subsidiary has any non-identifiable assets, and the classic one is goodwill, we're going to ignore those in our group accounts. We're also going to look at the parent company's liabilities. And we're going to add to that the subsidiaries' liabilities, again, after we've made fair market value adjustments. And remember, we bring in 100% of the subsidiaries' assets and liabilities post fair market value adjustments, even if we don't own 100% of the equity capital. And that's because our group accounts are going to reflect control rather than ownership. When it comes down to equity in the group accounts, what are we going to see? Well, our equity is going to be the parent company's share capital. It's going to be the parent company's retained earnings and any other comprehensive income. We're going to see minority interests in there as well. Minority interest may be discussed or described as non-controlling interest. Remember, we're going to bring in 100% of the assets and liabilities of our subsidiary, even if we don't own 100% of the share capital. That means we're bringing in net assets that don't belong to our shareholders. Those net assets that don't belong to our shareholders, well, that's what the minority interest will be. But what about retained earnings in the subsidiary? Do we bring those into our group accounts? Well, the idea is you can bring in your share of post-acquisition retained earnings in the subsidiary. What does that mean? Well, at the date of acquisition, all of the retained earnings in the subsidiary are pre-acquisition retained earnings and can't be included. However, at balance sheet dates after acquisition, we can bring in our share. So if you owned 80% of the equity capital, you could bring in 80% of post-acquisition retained earnings. So how does that actually work? What are post-acquisition retained earnings? Well, of course, what we're going to do is bring in our share. And the way we work out post-acquisition retained earnings are by looking at the retained earnings at the current balance sheet date in our subsidiary and comparing that to retained earnings at the date of acquisition. So in other words, that shows us the retained earnings that have been generated after the acquisition date, and we can bring in our share of those and include them in stockholders' equity. The same is true of other comprehensive income items as well in our subsidiary, although I doubt you'll see that in a question. So just be aware, therefore, we're looking at three sets of accounts. And remember, the key with the group accounts is we've got the shareholders of the parent, they own the parent owns the subsidiary, and what we're trying to do is report the parent and subsidiary as if they were one combined entity. Okay, in other words, when we look at control, the subsidiary is nothing more than an extension of the parent company. Okay, so let's look at the steps that we're going to run through when we're producing our group accounts. First of all, you may well be given pre-acquisition accounts of the parent and subsidiary. Pre-acquisition accounts simply means no transactions relating to the acquisition have yet been recorded, and that includes any debt or equity that the parent company might raise to finance its investment in the subsidiary. So first of all, we need to record any finance raised, and this is going to be in the parent company's accounts. So why might they raise finance? Well, they may raise finance to actually generate the funds for the acquisition. So it could be that they're issuing shares, in which case we'll see an increase in equity. It could be that they're issuing debt, in which case we'll see an increase in debt. The other side of this transaction, of course, is a corresponding increase in cash. We then reduce cash and record the investment at cost in the parent company's accounts. So essentially what this is going to do, this bit here, is it's going to reduce the balance sheet cash, which is in current assets, and instead we're going to record an investment, what we paid to acquire the subsidiary. And that shows up in the parent company's accounts. Key thing though, is it doesn't show up in the group accounts. Remember, in the group accounts, what we're going to do is show goodwill and essentially the net assets that we've acquired post fair market value adjustments. Now, if you're going to show net assets and goodwill and the purchase price, you essentially would double count everything. So we're going to eliminate the purchase price in the group accounts and show assets and liabilities instead. Okay, so notice that's that step there. Eliminate the investment account. Okay, so remember, in the parent company, we've got the purchase price, but that does not appear in the group accounts. And notice they say as well, any pre-acquisition equity accounts of the subsidiary. So remember, we're talking about the retained earnings that in the subsidiary that were generated prior to the date of acquisition. They cannot be included, only post-acquisition retained earnings. Create minority interest. We may well need to create a minority interest. Now, if we've acquired 100% of the subsidiary, there isn't going to be minority interest. But let's say we've only got 80% of the share capital. Well, remember, we're bringing in 100% of the assets, 100% of the liabilities, and therefore 100% of the net assets of our subsidiary post fair market value adjustments. So we've brought in assets and liabilities that don't belong to our shareholders, so we're going to create a minority interest. Now, we're actually going to see, when we look at minority interests and goodwill, there are actually two methods of calculating these figures: partial and full goodwill methods. And we're going to look at them in a few slides' time. So we're going to create a minority interest. We'll also create goodwill. Now, we looked at goodwill when we looked at acquisition accounting for associates. And we said with an associate, we've got that one-line consolidation, but within that one-line consolidation, there was a goodwill figure. And of course, that goodwill figure was the difference between the price we paid to acquire the associate and our share of its fair market value net assets. Well, that's actually referred to as partial goodwill. So we're going to create a minority interest. We're going to create goodwill. Then step 5, we combine 100% of the assets and liabilities of both firms after netting out any intercompany transactions. Now, typically intercompany transactions in the balance sheet would be loans between the parent and the subsidiary and vice versa. So we're going to ignore those or strip them out. So let's have a look at a numerical example and see how this works. So we've got a transaction on the 1st of January. We've got company P, the parent, acquiring 80% of company S for 8,000 cash. So that is our purchase price. And remember, that is going to appear in the parent company's balance sheets, essentially, but not in the group accounts. So use the following pre-acquisition balance sheets to consolidate the investment. Okay, so first step we can see is the recording of the investment in the parent company's accounts. So we've essentially recorded an investment of 8,000 and a decrease, of course, of cash, because they've spent that cash acquiring the subsidiary, of 8,000 there. So actually what that would mean in the parent company's accounts, essentially what you'd see is the current assets dropping to 40,000 and an investment being recorded at 8,000. Notice, of course, there's actually no change in the total assets of the parents as a result of this. But remember, we could, of course, be raising debt or equity finance. And if you were raising debt and equity finance, then, of course, your balance sheet debt or your balance sheet equity would change. And therefore, you would see a change in total assets. Okay, step 2. Remember, in the group accounts, of course, we don't show the investment at purchase price. Remember, we're bringing in 100% of the assets and liabilities. So notice that step 2 is just deducting that 8,000, the purchase price, so that in the group accounts, the investment is not recorded at purchase price. What we then do, of course, and that's step 5, is we're going to bring in 100% of the assets and liabilities of both companies. So notice we're taking the 40,000 current assets that are showing in the parent companies, and we're adding the full 16,000 current assets in our subsidiary to get our 56,000. Likewise with the other assets, we're taking the 32,000 in the parent company and adding the full 8,000 from the subsidiary. So notice again, just worth stressing one more time, that we're bringing in 100% of the assets and liabilities of our subsidiary, because our group accounts reflect the assets and liabilities controlled by the parent, not the assets and liabilities that are owned by the parent. Okay, now notice we haven't got a goodwill figure in here. Now, why haven't we got a goodwill figure? Well, let's just have a quick look at partial goodwill, and we'll actually see this on a slide in just a second. But if we were to look at partial goodwill, well, essentially, if we look at our purchase price, we spent $8,000. And if we look at the share of net assets that we've acquired, well, let's have a look at our subs net assets. So it had assets of 24,000. It had liabilities of 14,000. So essentially, its net assets were 10,000. Now again, in the real world, we'll make fair market value adjustments to our subsidiaries' balance sheet net assets before we start to consolidate, and we'll bring that in a little bit later in a further example. Okay, but in this example, we've got no fair market value adjustments. So what we then do is compare that to our share of the net asset figure. Remember, we've got, in this particular case, 80% of the company. So let's multiply by 0.8, which means we've acquired net assets worth 8,000. And of course, the difference between your purchase price and your share of the identifiable fair market value net assets is goodwill. And you'll notice, therefore, in our current example, the goodwill figure is actually 0. Okay, so there is goodwill in this example. It just happens to be a value of 0. We'll have a look at when goodwill isn't 0 in later examples. Okay, what else do we need to look at? Well, we need to look at the bottom of the balance sheet, essentially, our liabilities and our stockholders' equity. So the total liabilities, again, look, we're just going to add them together for both companies, taking 100%. So 40,000 and 14,000, giving 54,000 as our consolidated liabilities under acquisition accounting. But now we turn our attention to stockholders' equity. So these three accounts here being our equity accounts. And we're going to see minority interest here. And that's because we brought in all of those assets and liabilities from our subsidiary. We brought in 24,000 of assets and 14,000 of liabilities, which was 100% of the assets and liabilities, but we only actually owned 80%. So essentially, to get our minority interest figure, and you'll see the computation on the next slide, what we've done is we've said, okay, the fair market value net assets of our subsidiary are 10,000, which we calculated just a few seconds ago. How much of that belonged to the minority shareholders? Well, if we own 80%, the minorities own 20%, so times 0.2, and that gives us 2,000. That represents the net assets belonging to minority shareholders. And essentially notice that is our minority interest figure that appears in the group accounts. It's a component of stockholders' equity. It's a bit of a funny component of stockholders' equity. Is it really stockholders' equity? Well, in a way, not really, because it doesn't actually belong to our shareholders. It belongs to the minority shareholders. So really, it's almost like a perpetual piece of debt rather than a component of stockholders' equity. And in fact, US GAAP used to treat it as a form of perpetual debt, didn't include it in stockholders' equity. These days, both US GAAP and IFRS do treat minority interests, otherwise known as non-controlling interests, as a component of stockholders' equity. Then we've got the common stock. The common stock, of course, is simply the parent company's common stock. So notice, essentially, we're eliminating here the common stock and additional paid-in capital of our subsidiary and only reflecting the parents. Here, we're looking at the balance sheet at the date of acquisition. And at the date of acquisition, remember, this full 4,000 retained earnings in our subsidiary is all pre-acquisition and cannot be included. Therefore, at the date of acquisition, and in the exam, it's most likely you'll be producing a consolidated balance sheet at the date of acquisition. When we look at retained earnings, we're just seeing the parent company's retained earnings. So when we add our liabilities and our equity together, we get 96,000, the same as our balance sheet assets. Okay, there's those calculations of minority interest and goodwill that we saw before. So notice what they're doing is looking at the fair market value net identifiable assets of the subsidiary. And remember, we calculated those earlier by saying its assets were 24,000 and its liabilities essentially were 14,000, which gave us the 10,000 figure you're seeing here. Minority share, 20%, and that's what gave us our non-controlling interest or minority interest. Partial goodwill, and this is partial goodwill. We're going to see something called full goodwill later. But our partial goodwill, we're looking at what we spent to acquire the subsidiary compared to our share of fair market value identifiable net assets acquired. So 8,000, we've being the proceeds, less our share of identifiable net assets. So our share, 80%, the identifiable net assets, well, of course, 24,000 minus 14,000, 10,000, giving us, as we saw, goodwill of 0 in our particular example. So let's just compare the difference between equity accounting and acquisition accounting. So equity accounting, remember, we're going to use this for joint ventures and associates. Acquisition accounting, we're using for entities that we control, aka subsidiaries. And the first thing to notice is the difference in your total assets. Look, we've got much higher total assets under acquisition accounting than we have under equity accounting. Why is this the case? Well, of course, it's this idea of the one-line consolidation under equity accounting. What we've done, remember, that figure essentially reflects goodwill plus the share of fair market value net assets acquired. And the key is, it's the share of fair market value net assets. So we're netting assets against liabilities in this one-line consolidation under equity accounting. Under acquisition accounting, we're not netting assets against liabilities. We're showing the assets from the subsidiary separately and adding them to the parent company's assets. and we're showing the liabilities separately and adding them to the parent company's liabilities, but there's no netting of them. So therefore, our total assets are going to be higher under acquisition accounting. Notice the same is true when we look at liabilities. Under equity accounting, when we look at liabilities, we're simply seeing the parent company's liabilities. But under acquisition accounting, we're seeing the parent plus the sub together. So liabilities are going to be higher under acquisition accounting. What about stockholders' equity? Well, look, stockholders' equity essentially under the equity method is simply the parent company's stockholders' equity. So here we've got 28 and 12, essentially giving us 40,000. But look, under acquisition accounting, here's our stockholders' equity, and note it is a little bit higher. And the only reason it's higher is because of the minority interest. Okay, so if there was no minority interest, note that both methods would give you the same equity. But because of the minority interest, under acquisition accounting, our equity is slightly higher. Now, of course, that means equity-based ratios, things like, let's say, return on equity, net income over stockholders' equity. Well, under acquisition, if your equity is higher, these ratios are going to be lower. In practice, a lot of analysts actually will remove the minority interest before calculating equity-based ratios, on the grounds that it isn't really a component of your stockholders' equity because it doesn't belong to your shareholders. Okay, that's what happens in the real world, but that's not what happens in the CFA exams. So include the minority interest within stockholders' equity for any equity-based ratios unless the examiner specifically tells you to remove it.